Turn on the news right now, and you'll see a US-Iran military conflict sending oil prices toward $120 a barrel, levels not seen since the early days of the Ukraine war. You'll see wars, tariffs, political chaos, and economic warnings. And if you have any money invested, or you're thinking about starting, you're probably asking yourself, is this even worth it right now? Should I wait? Should I pull out? Is 2026 the worst possible time to invest? Today we're going to answer that with real data, not opinions, not headlines. Data. Let's start with what's actually happening. Geopolitical risk in 2026 is genuinely elevated. BlackRock's Geopolitical Risk Indicator, one of the most widely followed measures in the world, rates current global risk as high, calling this an extraordinary start to the year. The Russia-Ukraine war has now passed 1,400 days. The Middle East conflict continues, and as of this week, the United States and Iran are in direct military conflict, with oil spiking toward levels not seen in 4 years. US-China tensions over Taiwan and technology are intensifying. Trump's tariff policies are reshaping global trade. The Federal Reserve Chair's term ends in May, and his replacement is uncertain. Europe is politically fragmented, and confidence among consumers and businesses is falling. These are real concerns. I'm not going to pretend otherwise, but here's what the data actually shows about investing during times exactly like this. Since World War II, there have been 29 major geopolitical crises: wars, attacks, invasions, financial collapses. According to research by Glenview Trust, stocks were higher 1 month after the crisis in 66% of those events, higher 1 year later in roughly 70% of cases. The average 1-year return following a geopolitical shock has historically been in the high single digits. When Russia invaded Ukraine in February 2022, markets initially dropped around 8%. The S&P 500 has since risen over 50% from that point. When Hamas attacked Israel in October 2023, markets rose nearly 10% in the following 3 months. After 9/11, arguably the most shocking geopolitical event of this century, the S&P 500 bounced back over 21% in just 10 weeks. After the Gulf War's 17% drop, the market ended 1991 up over 29%. The pattern is clear. Markets react to fear in the short term. Then they recover. Then they go higher. Why? Because what actually drives stock prices long-term is corporate earnings, innovation, and economic growth, not headlines. When you invest in an index fund tracking the S&P 500 or a European equivalent like VUAA, you're not betting on peace in the Middle East. You're owning shares in hundreds of companies whose employees are still going to work, whose customers are still buying products, and whose engineers are still building the future. Wars are tragedies, but they don't shut down Apple, Microsoft, or the thousands of other businesses that make up the global economy. Think about your own daily life right now. You're still paying bills, using your phone, buying food. Billions of people around the world are doing the same thing. That economic activity doesn't stop because of a conflict on the other side of the world. Now, should you do anything differently given the current environment? Yes, a few things. First, diversify. Don't put everything in one country or one sector. A mix of global index funds spreads your risk across hundreds of economies. Second, keep investing regularly, what's called dollar-cost averaging. Put in a fixed amount every month, regardless of what the market is doing. When prices drop, you buy more shares for the same money. Third, hold cash for your emergency fund first. 3 to 6 months of expenses, untouched. That way you never have to sell investments at a bad time just because you need money. And fourth, don't panic sell. The single most expensive mistake investors make is selling during a drop and locking in a loss permanently. Studies consistently show that missing just the 10 best trading days in a decade can cut your returns in half. The honest answer to the question is this: no, there is never a perfect time to invest. There will always be something scary in the headlines. But history shows clearly that the people who kept investing through wars, recessions, and crises consistently, patiently, came out ahead. The people who waited for things to calm down often missed the best recovery gains. The best time to start was yesterday. The second best time is today. If you found this useful, subscribe. New videos every Monday, Wednesday, and Friday. And drop a comment. Are you still investing right now, or are you waiting? I'd genuinely like to know. See you next time.